Now that I have everyone's attention, I will start by giving you a brief of our company, Nadeem and Umendra Chartered Accountants. We have been in business for the past 13 years, and our name features in the approved auditors list of all the free zones in the UAE, all the local banks, real estate and regulatory authorities, and various small authorities as well. We have our four offices in three emirates of the UAE. In Dubai, we have our head office at Al Khalid Center in Par Dubai and a branch office in Almas Tower GLT. In Abu Dhabi, there's a branch in Al Falah Street, and in Sharjah, there's a branch in Hamria Free Zone. We provide a various spectrum of services. You can find them. Our services ranges from accounting and bookkeeping, VAT consultancy, auditing and assurance, internal audits and system reviews, business incorporation in UAE, free zones or offshores, mainland as well. The company liquidations, business valuations, due diligence and feasibility studies, ISO certification and consultancy. And our services related to economic substance regulations, anti-money laundering, ultimate beneficial ownership, and corporate tax as well. We aim to be a one-stop solution for all your accounting needs. Our agenda for today's meeting is to cover all these points mentioned below. Starting with the key points of the UAE corporate tax, there was a webinar which we had held in February, and that would be a brief recap for the previous webinar. The taxable persons, the permanent establishment, transfer pricing with the related persons or the connected persons with the corporate tax, free zone applicability, the calculation of the taxable income, adjustments and carry forwards of losses, the administration, and we shall end the meeting with a quick Q&A session. And I shall ask Mr. Sameer Popat now to help us with the previous session.
Okay. Thank you so much, Khushbu. Hello, everyone. Good afternoon. And Praveenji, let me share this screen. Yes. Thank you so much. So first, I'll just be quickly briefing through the last webinar which we had done in February, back in February, when UAE recently had introduced on 31st of January the UAE corporate tax. And accordingly, we had brushed through some of the FAQs that the FTA had declared, the Minister of Finance had declared, and I'll just quickly brush through those so that those who are joining us for the first time or joining this webinar for the first time will get a fair bit of idea of the UAE corporate tax if they have not been gone through yet. And it will give a quick base, and then we'll be discussing in detail about different concepts which Ms. Khushbu already shared the agenda for today. So in our last webinar, we did an intro of what is the corporate tax and how it's different from the UAE VAT law, because VAT is an indirect tax, and the corporate tax is a direct form of tax. By direct tax, we mean that the tax will be paid out of the company profits. Earlier, VAT, it was indirect tax because it was, you were just, when you are selling the goods, you are collecting the tax from your customers. But corporate tax is different in that respect, that it's a direct tax, and the tax will have to be paid out of your profits. Second, and that's what is corporate tax we discussed. And we also discussed that the UAE has decided the tax rate of 9% on profits, annual profits of the company above AED 375,000 dirhams. So there is a relief for SMEs that up to initial 375,000 dirhams of profits, there will be zero tax, and anything above 375, it will be charged at 9%. When it will be effective from? It will be effective from 1st June 2023. And we'll see in my later slides that how it will depend on different companies following different financial years, how it will be applicable. So why UAE introduced incorporate tax? It was to cement the UAE's position as a world leading hub, and also it will lead to transparency in the economy, which will lead to more attraction of foreign funds, and the investors, foreign investors, will have more confidence in investing in UAE economy and UAE based companies. I'll not go in much detail. Then we had a brief comparison of different types of different tax rates and regimes in Gulf countries, and also we compared with Singapore how UAE corporate tax will be faring. The corporate tax rate of 9% is the lowest among the GCC, except for Bahrain, where currently there is no tax implemented yet. Apart from that, as compared to all the GCC countries, the tax rate introduced by UAE is the lowest, and also there is a threshold relief of 375,000 dirhams, almost $100,000. So benefits, yeah, it's okay. Applicability, so unlike VAT, the tax will be applicable to all the businesses. There are no exempt businesses. So there are few that we'll be discussing. And in general, any entity who is conducting business in UAE the UAE corporate tax will be applicable. And there is a condition-based applicability to individual and entities, which in detail will be explained by us later on. There are few exemptions, and one of them being the extraction of natural resources. The entities or companies who are involved in extraction of natural resources, they are already being taxed by UAE government at a very high percentage, and those will be exempt from UAE corporate tax. Second, the companies that are falling under Pillar 2 definition of OECD BEPS project, which is the companies all over the world who has a turnover of more than 750 million euros, they will be charged a minimum corporate tax of 15%. It's called minimum alternate tax, which all the countries who are the part of OECD, they have taken the decision to implement tax worldwide in all those countries for the companies, MNCs basically, whose turnover annual is more than 750 million euros. So they will pay tax at the rate of 15%, irrespective of in which country their operations are. Then there are the, as per UAE corporate tax, there is exemption of capital gains and dividends. We'll see and talk about it more later in detail. And there are qualifying intragroup transactions and reorganizations. So these are the basic exemptions. The timeline, as I said, the UAE corporate tax will be effective from 1st June 2023. So just to take an example, for companies who are following financial year from June 23 to May 2024, for them, their first taxable period will be from 1st June 2023 till 31st May 2024. And their first return filing will be 9 months, will be within 9 months of the end of the taxable period. Similarly, companies who are following the financial year of Jan to December, that is the calendar year as their financial year, for them, the first taxable period will be starting from 1st Jan 2024 and not 1st Jan 2023. So companies following Jan to December, first taxable period will be 1st Jan 2024 to 31st December 2024, that is the calendar year, and they will be filing their first tax return, and they will have to pay the corporate tax as well, which will be calculated as per the tax return within 9 months of starting from after 31st December 2024. So basically by 30th September 2025, you will be filing your first tax return and also paying the corporate tax. And accordingly, for companies following financial year from April 2024 to March 2025, their first taxable period will be from 1st April 2024. So they are the ones getting the maximum benefit, because corporate tax is effective from 1st June 2023. However, for the companies following April to March, their first tax return and taxable period would be from 1st April 2024 till 31st March 2025. And accordingly, after the end of the financial period, they have 9 months to file the corporate tax return and as well as pay the tax. Free zones I'll be covering in detail in the later part of the presentation, but just to give you an idea, the free zones will be required to register for tax, but the tax rate for free zone entities, if they follow the conditions that are mentioned as per and the proposed conditions, if they follow that, then it will be 0%. Otherwise, it will be taxable. We'll see later on how its applicability to the free zones. Tax rate and computation of net taxable income. So as I mentioned earlier, the initial 375,000 of the profits of a company is non-taxable. So there won't be any tax charged on the initial 375,000 of the profits. Any profits a company does above 375,000 dirhams will be taxed at the rate of 9%. And the base of calculating the net profit is as per the accounting which you will maintain and normal generally accepted accounting principles. You will have to calculate your net profit, and that net profit you will have to give some adjustments with respect to depreciation. There are some limitations to the expenses as well, which we'll be talking in the later part. And the profit as per the UAE corporate law, which will come on that initial 375 will be free, and any profits above 375 will be taxed at the rate of 9%. These were some of the FAQs, and what should the businesses do now? We had discussed in detail last time. So this was our previous webinar. So in case anyone of you want to look at that webinar in detail, then the link is present. Khushbu, if you can share your screen. So yes. Then you can start. Yeah, so this is the link where you can download it. Over to you, Khushbu. Thank you.
Thank you very much, Sir Sameer, for the explanation for the previous webinar with regards to the corporate tax. Now, without any further ado, let me invite Mr. Pratik Patel. He will take us through the agenda of the following topics, which is the taxable persons, the permanent establishment, transfer pricing with related person, and the connected persons with regards to the corporate tax. At present, Mr. Pratik is having over 12 years of experience in the areas of taxation and auditing. He has a knack for problem solving and a flair for understanding the ever complex and evolving arena of taxation. Being an avid reader, he continuously updates himself with the latest happening in the areas of taxation, be it domestic as well as international, accounting standards, IFRS, latest judicial rulings, corporate laws, FEMA, etc. Over to you, Mr. Pratik.
Hello, good afternoon, everybody. Thanks for joining us. As you all are aware that the UAE will gonna implement the corporate tax from 1st June 2023. And you are also aware that the tax will be applicable on legal persons and natural persons. Now we know that who are legal persons and natural persons. So the UAE corporate tax has broadly categorized the basis of taxation.
Pratik, please start your presentation.
Yeah.
Your folder view is there.
Yes. Now, what is the basis of taxation now? The basis of
presentation is not visible to anyone.
Already.
You need to stop screen sharing and start sharing screen again.
Okay, just hold on.
Sorry for the interruption, guys. Yeah.
Yes. Now it is
Start
visible.
the slideshow.
Yeah. So in every robust corporate tax system, the jurisdiction which tax the person's income broadly categorize them in the basis of taxation. So in line with the global practices, Ministry of Finance has also proposed to categorize the basis of taxation in two categories, namely resident category and non-resident category. So who are resident? If you are a resident in UAE, then your global income will become taxable in the UAE. Now, who are resident, a legal person that is incorporated in the UAE will be considered by reason of their incorporation as a resident in UAE. Now, if you are natural person, means living individuals and carrying on business in the UAE, then you are also considered as a resident if you are required to obtain the permit or license for carrying business in UAE. If you are partner in unincorporated partnership, then also you will be considered as a resident. Again, if you are a foreign company and if you are not registered in UAE, then also you will be considered as a resident.
Sorry to interrupt. Make it full screen, please.
Hello.
Make it full screen.
Hello. Is it okay now?
No. Okay, I'll ask someone to
Hello.
just a minute.
Is it visible now? I can continue. Hello. Yeah. Okay.
Yeah, now it's done. Okay.
Okay. So, sorry for the interruption. Now, if you are a foreign company, say if you are not registered in UAE, neither you are natural person registered in UAE, nor you are legal person incorporated in the UAE. If you are a foreign company, say for you are located in Australia and doing business in a UAE. Now, what is the criteria? If you are a foreign company, but if you are effectively managed and controlled from UAE, then you'll be treated as a resident and the foreign company's income will be taxable in UAE. Now, what is the meaning of effectively managed and control in the UAE? Generally, these guidelines will be provided in due course when the final legislation will be arrived. But if we consider the mechanism of developed countries and what practice prevails in developed countries, then your key managerial persons who are responsible for effectively managing the day-to-day operations of a business and who are responsible for taking key managerial decisions which are crucial for the overall survival and existence of the organization. If those kind of persons are sitting in UAE and taking the decisions for the overall growth and survival of the company, although the company is foreign company and not registered in UAE, then in spite of being foreign company, it will be treated as a resident in UAE and its global income will become taxation in UAE. So moving forward, if you are not resident in UAE, it means if you are not a legal person registered in UAE, nor your natural person, nor your partner, or nor your foreign company meeting the criteria of effectively manage or control in UAE, then you will be considered as a non-resident. Now, if you are non-resident, then generally the UAE jurisdiction has no right to tax your income, but there are certain exceptions. It means if you are non-resident and you have a permanent establishment in the UAE and the income which is sourced out of UAE, then but naturally the UAE has a right to tax your income because the UAE government or authority will insist that you have generated income from UAE, then by reason of profit derived from UAE, you are required to pay tax in UAE. Now, what is considered under the definition of permanent establishment? Friends, we know that, I don't know how many of you are aware or not, the concept of permanent establishment is borrowed from the OECD's Model Convention on Double Taxation Avoidance and Agreement. The Article 5 has laid down certain criteria for the determination of permanent establishment. Generally, there exists a permanent establishment when there is a fixed place of business or business is being derived through dependent agent. Now we have to understand what is fixed place of business and dependent agent. I will take up first what is the fixed place of business. It means if you have fixed place of business and if you have a dependent agent in UAE, although you are non-resident, then income attributable to the fixed place of business or dependent agent will become taxable in UAE. Now what is fixed place of business? Now generally fixed place of business is a business which is having some sort of permanency, and through which the business is being wholly or partly carried on in USA. Now in UAE. Now we have to understand the meaning. What is wholly or partly? Wholly or partly. They haven't said the wholly carried on in UAE. Neither they said only partly. It means if you are carried partly business in UAE and you have some sort of permanence presence in UAE, then also you will be treated as having a permanent establishment. Now, what is covered under the permanent establishment? We can say that there are certain examples provided in the public consultation documents. Like if the foreign company or non-resident is having a place of management in UAE, if they have management office, branch office, workshop, through which the economic activities being carried out in UAE jurisdiction, then they will be considered having permanent establishment. So when you are having permanent establishment, then but naturally you are doing economic activity in the UAE, then you earn the profit. So UAE government will definitely ask the share of revenue in the as a tax in the profit earned by the non-resident. Now moving forward, what is a dependent agent? So when the foreign company doesn't have any permanent establishment in the nature of workshop nor a management office, but they have a dependent agent through which the business is being done in the UAE. Now, who is a dependent agent? Dependent agent is a person who generally wholly and exclusively work for the non-resident and fetches the business for the non-resident person from the UAE. So when you have such kind of arrangement in the nature of dependent agent, then those non-resident will be considered having permanent establishment in the UAE, and then their income will be chargeable to tax in the UAE. Now, what is the source of income in UAE? Another condition need to be satisfied. The non-resident must be having a permanent establishment in UAE and its income sourced out of UAE. Now, in the public consultation document, the definition of sourced out of UAE is not provided. And we expect the final legislation will provide the definition of what is being treated as a sourced out of UAE. But generally, if any payment is linked with the permanent establishment, then it is considered as an income sourced out of UAE. So detailed guidelines and procedures are awaiting, and we expect the final legislation will provide detailed guidelines on that. Now, moving forward, let me remind you that if permanent establishment definition is fulfilled, then you have to pay tax in the UAE. Now, moving forward. Now, another concept is taken in the public document is transfer pricing. Now, what is the reason the transfer pricing provisions are also being considered in the public consultation document? The reason is transfer pricing provisions are generally being introduced to act as anti-abusive provisions. So we know that corporates and businessmen are making payment to their individual related or their related entities having a cross shareholding and cross ownership. So in order that the corporates does not have any charm to shift the profit from high tax jurisdiction to low or no tax jurisdiction, this kind of transfer pricing provisions are always you will find in a jurisdiction when there is a robust taxation systems are there. Now, when transactions are taken place among or between the related parties, then those transactions are subject to compliance with the transfer pricing regulations. The detailed procedures, rules, regulations, and methods for determination of arm's length price is yet awaited in the final legislation. We believe that they will provide in final legislations. Now, when there are transactions with the related persons, then we have to determine the arm's length price of those transactions. Now, it is interesting to understand that who are the related persons and who are the connected persons, because any transaction with the related persons and connected persons are required to comply with the arm's length principle of the OECD model and commentary on transfer pricing. The OECD has given a detailed commentary on that, but we will not go detail into the various methods for determination of arm's length. Now I'll take up who are related persons as provided in the public consultation documents. The individuals who are related up to the 4th degree of kinship and affinity, the individuals who are controlling by reason of being with the relatives, the other legal entity having a ownership up to 50%, or they control the other legal entity. Now, what is the ownership up to direct and indirect, and what is control is not being defined in the public consultation document, and we expect that those procedures and detailed guidance will be provided in the final legislation. Now, second category is when an individual along with the legal entity together with its related party directly or indirectly own up to 50% or more or control the other legal entity, then the legal entity which controls and the individuals who controls are considered as a relatives. Now, the third category is two or more legal entities together with the related parties control the other legal entities. Now here the two or more legal entities who controls the other legal entity together with its related parties are also covered as a related party. Now a taxpayer and its branch or it's having a permanent establishment is naturally considered as a related party. Other categories, partners in the partnership firm is also a related person. Exempt and non-exempt business of a same person, say proprietor is having a business in a mainland and another business in a free zone, and they trade between these two businesses, then also those transactions are subject to arm's length because those transactions are with the related parties. So in a nutshell, wherever there is any transaction with the related parties, then those transactions need to comply the arm's length principle of transfer pricing rules and regulations. Now the other category that they have provided is connected persons. Now friends, what is important here is both the definitions are similar, but the definition of related parties, it also includes the legal persons, legal entities, whereas the connected persons includes only individuals and it's related. It means if you are taxable person can be anyone. It means legal person or a natural person, but any taxable person deals with the connected persons if they made any payments or provide any benefits to the connected persons, then those benefit and payments will be allowed as a deduction from taxable income only when they demonstrate that the payment or benefit is at the market value and comply with the arm's length principle and is incurred wholly and exclusively for the purpose of business. Now, what is incurred wholly and exclusively for the purpose of the business is not yet provided, because what is wholly and exclusively for the business is the business prudence of a businessman. It is within the domain of a businessman that what is a wholly and exclusively expenditure necessary for my business or not, that is the domain of businessman, and we expect they will provide what is the expenditure to be considered as wholly and exclusively, and what are the business, what are the expenses not considered as wholly and exclusively. So when you made any payment or provide any benefits to the connected persons, then both the conditions need to be complied. Otherwise, the UAE tax authority will not allow the expenses as deductible expenses while computing the taxable income. Now, who are connected persons? Connected persons means an individual and the persons related to the individual up to the fourth degree of kinship or affiliation, a director or officer in the taxable person. We know that directors or officer or any other key managerial persons, by reason of having their authority, can influence the expenditure. I mean, they can influence the expenditure or suppress the revenue, and thereby they can evade the taxes. So this is the reason why the directors, officers, and key managerial persons are considered as a related or connected persons in the definition. Another category is individual related to the owner, director, or officer of the taxable person up to the fourth degree of affiliation or kinship. Again, a partner in the partnership firm will be considered as a connected person. So when a partnership firm makes a payment to partner, then they'll have to demonstrate that the payment or benefit is reasonable having regard to the market value of goods or services provided by the partner against which payment is being made to the partner. And the last category is related party of any of the taxable person, directors, or partners. And that's it from my side, friends. If you have any questions with regards to the transfer pricing, connected persons, related persons, permanent establishment, dependent agent, or anything, I'll take up the questions at the end of the sessions. Thank you very much.
Thank you very much, Mr. Prateek. Now I shall request Mr. Sameer to give us a brief idea on the further topics. However, I would like to introduce Mr. Sameer first. Mr. Sameer is the director of Nadeem and Umendra Chartered Accountants, TMCC branch. He is a qualified chartered accountant from India and has more than 15 years of experience working with various MNCs like Al Shirawi Group, ARJ Group, etc. He has an expert knowledge in GCC, VAT, excise law, and ESR. He has conducted numerous seminars and webinars in the last few years. Mr. Sameer, please explain us with the core aspects of free zone applicability and the calculation of taxable income.
Thank you so much, Khushbu. I believe we were going through the most of the questions in the registrations as well, and most of them were worried about what's the free zone applicability, what kind of transactions will be taxable, will be in the purview of UAE corporate tax law. So we'll be having some kind of clarity. But before that, let me give you a disclaimer in the sort that this document, which has been recently released by the UAE Ministry of Finance, is for public consultation. It's not the final law. And also the views from our side is based on the understanding of that public document. So please don't consider it as a final, consider it as a knowledge gaining exercise. And it will for sure give you more clarity, but it's not final. And the Ministry of Finance has asked all the general public to go through the draft key points. It's not a complete law as well. It's just the key points, to go through that. And in case you have any suggestions to the Ministry of Finance or FTA, you can put your suggestions forward to the FTA and it will be considered as by them, if it's logical as well. Yeah. So for the free zone applicability, as we had mentioned before, that the UAE is gonna, the promises which all the free zones have given to their entities of 50 years, no tax, no income tax, no corporate tax, they are gonna honor that promises, because the contribution of the free zones to the UAE economy has been immense. So considering that, companies that are registered in free zones, they will not be liable to pay the tax at the rate of 9%. However, there are certain conditions attached to it. These conditions are attached to make sure that there is no unfair treatment to the mainland business, or there is no unfair advantage to the free zone businesses as compared to the mainland businesses. Being a free zone company, if you go the detailed guidelines of functioning in a free zone, you know that you are not supposed to work with companies in mainland directly. We know in practicality, a lot of companies still do, and there are also free zones who are open, they are not bonded. And that's why, as per the VAT law as well, there is a segregation of designated zone and free zone. But in corporate UAE corporate law, there is no segregation as such specific between a designated zone and a free zone. All free zone companies, they will not be liable to pay tax at the rate of 9%, provided they provided they follow certain conditions. So now we'll look at what kind of transactions will not attract the 9% tax and what type of transactions will attract the 9% corporate tax. First is any free zone company transacting with companies outside UAE. It is not a problem. It's the core crux of registering a company in free zone, that either you do business within the free zone or you do business with companies outside UAE. In those cases, UAE corporate tax will not be applicable at the rate of 9%, and all the free zone companies just need to register for the UAE corporate tax and also file the returns. But irrespective of what your profit is, you won't be charged tax, or you won't be liable to pay tax at the rate of 9%. Second type of transaction is transaction within the free zone. So if you are doing any transactions within the free zone from, let's say, company A in DMCC free zone does or sold some good to a company B, or sell some services to a company B in Jafza free zone, then on such transactions as well, UAE corporate tax will not be applicable. It will still be at 0%. Then free zone entities having a branch in mainland UAE. Let's say, for example, a free zone entity registered with DAFZA, and they have a branch in mainland, and they have certain transactions wherein the free zone entity sells some goods to a branch in mainland. In that case as well, it will not be applicable, but no, that's for a different. So sorry. When a free zone entity has a branch in mainland UAE, the branch is normally considered as an extended part of the head company. But the UAE corporate tax has given the relaxation that in case, even if a free zone company has a branch in mainland, only the revenue generated by the branch which is located in the mainland, only on that branch, UAE corporate tax will be applicable at 9%. But in case the free zone entity, which is the head office of the branch, which is the main office, if they conduct any transactions which are outside UAE, on their revenue, UAE corporate tax will not be applicable. I hope it's clear. I can clarify again in the Q&A if you guys want. And any passive income earned by UAE, by the free zone companies from the mainland entities. What is passive income? Passive income can be your interest and dividends and capital gains. So in case, let's say, a free zone company has shares in a company in mainland UAE, when the mainland UAE company declares dividend, it comes to the free zone entity. Now this dividend income, it's like a passive income, and for the free zone company, it won't be taxed at the rate of 9% because the nature of income is passive, and the dividend and capital gains are exempt from the UAE corporate tax law. Another type of transaction is transaction between free zone companies and their group companies in mainland UAE. So in case a free zone company who has also a group company in the mainland UAE, and the free zone company sells any goods to the mainland company, in this case, the free zone company will not have to pay tax, but the group company who is in mainland, for the payments or the purchases done from the free zone company, they will not be able to take it as a deductible expense. So indirectly, they will be paying tax on that transaction. So that's to make sure there is parity and no unfair advantage or no unfair tax planning is being done by the companies present in the mainland. Next point which they are considering is any sale by a designated zone company, that is Jafza or Rakiz, the ones that are designated zone as per the cabinet decision for the VAT law, the companies who are registered in the designated zones, and these companies are selling goods, and it's only goods and not services, and these companies are selling goods to companies in mainland UAE. In that case, if you have practiced the UAE VAT law, so in such cases what happens is the company who is in mainland UAE becomes the importer of such goods, right? So in that case also, the designated zone company who is selling the goods does not charge VAT. And similarly, on these kind of transactions, when a designated zone company sells to a mainland company and the mainland company is the importer in records, on those transactions as well, UAE corporate tax will be applicable at 0 rate and not at 9%. Sale of goods to that we have already covered. Any other mainland sourced income, so any other apart from the above which we have discussed, any transaction or any revenue generated by the free zone company by selling to the mainland companies, the free zone that particular free zone company's whole income will be purview to the UAE corporate tax. Because if you check my last webinar as well, I had said that it's very difficult to charge tax on just one transaction. Let's say in a whole year, out of 100 transactions, you have done 90 transactions which are with the companies outside UAE, but 10 transactions or 10 times you have sold goods to the companies in mainland UAE. But how will the UAE FTA or the Ministry of Finance, how will they know that how much profit you have earned out of those transactions? So that will be very complex, and to discourage that, what they have put out is, any other, if you are selling to mainland companies apart from the transactions which are described above, then the whole company's revenue, irrespective of whether it has been done to the companies outside UAE, the whole revenue and the net profit based on the whole revenue of the company, the whole net profit of the company will be purview to UAE corporate tax at the rate of 9%. So you need to be careful. You need to carefully check, being in a free zone, what type of transactions you are currently conducting with the mainland companies. And in case if any restructuring is required, you need to take those steps at the earliest. Another condition which is specific to the free zone companies is that in order to take benefit of this 0% taxability on the profits of the free zone companies, they need to have their books of accounts audited. Now we know majority of the free zones in UAE has mandated the submission of audited financial statements to the authority, but there are few free zones which are still accepting without audited financials, but that will change. And if you want to take the benefit of UAE corporate tax law for the free zone companies at 0%, then you will need to get your annual financial statements audited by a certified auditor. Hope this clears the free zone applicability. Now next we'll see how the taxable income will be calculated. As I said, the the corporate tax at the rate of 9% will be charged on your net profits. So what is the basis of this profit? Do we need to follow special rules for it, or just normal accounting is suffice? So in that case, what the Ministry of Finance is suggesting, that they want to keep the compliance of UAE corporate tax to a very low level, so that the small companies do not incur additional cost in complying with the UAE corporate tax law. So whatever company's annual net profit is, as per their accounting entries, as per their proper accounting, it will be taken as the base for calculating the corporate income tax. And as of now, we see there are a lot of companies who even do not know what is their financial year. They don't bother preparing annual financial statement, which is not a practice we would suggest businesses should follow. But there are many companies who are not maintaining any books of accounts, not maintaining any accounting entries or ledgers, and they don't know their annual profits or even monthly profits. So in case they don't know the financial year, then the default financial year would be Jan to December. For companies who have their predefined financial year, they can continue with their financial year. It's not like back in India where the tax period is predefined from April to March. That kind of practice will not be followed. So you guys don't need to, the businesses will not need to change their financial year. You can continue with their own financial year. If it's not defined, not predefined, then you have to, then it will be by default January to December. That is the calendar year. Now, while calculating the net taxable profits, if you see in our balance sheet and profit and loss, now I think a lot of you guys would have completed your audits as well. There will be adjustments for unrealized gains and losses. For example, let's say you have and you have done the revaluation of those assets as on 31st December. Now, this is just revaluation. You have not actually earned or the profits are, it's just the revaluation of the asset and you book it as a profit in your accounts. Now, these kind of capital revaluations or capital unrealized gains or even losses will not be considered as part of the base of the net profit. It will have to be excluded in case, as per your accounting profit, you have a profit of 100,000 from the normal business activities, and then there is unrealized gain of 500,000 dirhams. Then this 500,000 dirhams, which is capital in nature, will have to be readjusted. It will be removed, and again your profit will be adjusted to 100,000, which is from operating only. So any unrealized gains or losses on capital items will be readjusted. However, any revenue related unrealized gains or losses are present in your P&L, that will be considered as part of your calculation of taxable income, and it will be allowed. So the example for such are revaluation of inventory. So if you are revaluing your inventory as on 31st December and there is an adjustment of on the valuation of the inventory, whether profit or a loss, it will be considered and accordingly the tax will be calculated. And also if there are any provisions or the currency adjustments, when we have any customers or payables in foreign currency, we give an adjustment to revalue and readjust the payables and receivables amount as per the currency closing rate and pass the adjustment to the P&L. So that also will be considered to calculate the net tax profit. Now, as we discussed earlier, there are some type of incomes which are exempt, on which UAE corporate tax will not be applicable. One such is dividend and capital gains, which we discussed earlier as well. But there is a minimum criteria which they have asked to follow. Only then it will be applicable, and then only then it will be exempt. Sorry. So one such condition is the minimum shareholding from the company from which you are receiving the dividend, or you are earning capital gains by selling the shares in that company. The minimum shareholding should be at least 5%. Now, the logic behind 5% is there are companies who are doing proprietary trading in shares and proprietary trading in mutual funds. So for those companies, they earn their profits from the business by trading in such shares. So it's not a subsidiary, and it's just trading in shares. And while they're holding shares in other companies or regulated stock markets, they also get dividend income from those shares. So in that case, it will not be exempt. For dividend or capital gains to be exempt, you should have a minimum shareholding of 5% in the company in which you are, in your subsidiary company. Only then it will be exempt. And another condition, if you are holding shares in a company which is outside UAE, in that case it will be exempt. The dividend or capital gains will be exempt only in case the foreign company in which you are holding shares, that foreign company is liable to tax in that in their own residence country at a minimum rate of 9%. If they are not paying any tax over there, then even the dividends and capital gains will be taxable in UAE. Another exempt income is foreign branch of profits. It is proposed that if a UAE company has a branch in a country outside UAE, then the profits of that branch company will be exempt from the UAE corporate tax law only if the branch is registered in the country, which is registered in the country outside UAE, is paying tax at the rate of at least 9% on the profits of the branch. Only then it will be exempt. Otherwise, as I said, branch is just an extended arm of the main company. So if the branch is not paying corporate tax in the country where it is registered, then it will be their net profits will be clubbed to the main company here in UAE, and it will be taxed at the rate of 9%. And the third exempt income which they have exemption they are planning to provide is to the operators and the people who are in the business of leasing of aircrafts or ships. So any entity, and the condition for this is the company should be non-resident. So please don't misunderstand. UAE companies who are the operators or who are leasing aircrafts or ships, they will be liable to pay corporate tax at 9%. But if a non-resident company who is operating or leasing aircraft or ships in UAE, then it will be exempt, provided the country from which the non-resident is, who is conducting the business, the country provides the same treatment to UAE businesses who are in the same business. So quid pro quo, I think that's the code applicable. Next is expenses deductions. There are some limitations which are already being discussed by the Ministry of Finance on what kind of expenses will be allowed and which will be disallowed. These are just few of those which they have declared. And the first is being the interest expense. Interest expense is being capped at 30% of the earnings before interest, depreciation, tax, and amortization. So let's say if you are actually paying an interest expense which is more than 30% of your EBITDA, then the interest expense above 30% will be disallowed, and you will have to add it back to your accounting profit, and corporate tax will be applicable on the additional amount as well. So there are some exemptions to it as well. And they are also planning to provide a minimum amount of threshold limit kind of thing, that okay, up to 100,000 interest is okay. Even if you are not falling under the category of 30%, it will be allowed. So minimum amount will be allowed to help small businesses, but apart from that, 30% is the max cap. And this 30% cap is not applicable to banks, insurance companies, or natural persons, and certain other regulated financial services entities. So it's not applicable to natural persons, because natural persons, when a person is doing a sole establishment, it's assumed to they have an unlimited liability which they are working with. So that is why that exemption they are planning to give to the natural person. Then condition with respect to, in case companies has related party loans, and there is that related party loan bears interest, then such interest will be deductible only if the loan has been taken for a valid reason, and also the entity who is providing the loan and who is earning the interest income should be subject to corporate tax. If it's outside UAE or inside UAE, should be subject to corporate tax at the rate of 9%. Otherwise, it won't be allowed. Next, they have put a cap on entertainment expenses. So irrespective of what entertainment expenses you are doing for your company, only 50% of those entertainment expenses will be allowed to deduct from the expenses, and the balance 50% will have to be added back to your profit. So let's say a company has done a profit of 1 million dirhams, out of which they have done entertainment expenses of 100,000. So after deducting 100,000, they have reached the net profit of 1 million. For calculation of corporate tax, you will have to add back 50% of the 100,000. Those are the entertainment expenses. So you'll add back 50,000, and then as per the corporate tax calculation, your net profit will be 1 million plus 50,000 of the disallowed entertainment expenses. So you will have to pay the corporate tax at the rate of 9, the balance 50%. then you cannot adjust any administrative penalties which you, if you, in case you have any fines from government authorities or fines from VAT or fines from any authorities, those type of penalties you will account it in your accounting profit, but it will have to be added back to calculate the accounting profit as per the corporate tax law. Then input VAT, if you're registered for VAT, it's understood that, or even if you're not registered for VAT, input VAT will not be allowed as an expense. You will have to add it back. In case you have incurred any input tax, you will have to add it back and calculate the corporate taxable profit after adding it back. And lastly, in case you are doing donations and the donations are paid to an unapproved charity organization, donation to a certain level to an approved charity organization is allowed. And even UAE wants to support the CSR initiatives taken by the company. But in case you are making donations to an unapproved charity organization, then those expenses will not be deductible and you will have to add it back to calculate your corporate tax profit. That's all from my side. I'll head back. I'll give the mic again to Khushbu to introduce our next speaker. Thank you.
Thank you very much, Mr. Sameer, for your in-depth knowledge of the concept. Moving forward, I would like to call upon Mr. Zaki, who shall continue with this session with a few more important and interesting topics like the tax administration and the adjustment and carry forward of the losses. Mr. Zaki is.
Thank you. Thank you, Khushbu, for handling me over. Yeah, so I will be, as Khushbu has mentioned, I will be handling the section related to tax grouping. So my screen is visible now, Khushbu?
Sameer, you need to stop the screen sharing from your end so that the key will do. Zaki, you can do now.
Meanwhile, I would like to introduce Mr. Zaki. So Mr. Zakir Rahman is a CA with rich experience in taxation in the UAE. His experience encompasses not only the basic tax consulting, but also tax planning, tax audits, and appeals. Over to you, Mr. Zaki.
Thank you again, and warm welcome to all the participants. The area that I will be highlighting, it includes the provisions that are related to the tax grouping. Now, the idea of tax grouping in income tax law, in the purview of income tax law, shall be very different to the idea of tax grouping that we already have in relation to value-added tax. So, in relation to the tax grouping and the income tax, the idea is that there can be a number of entities conducting business under a group, and they may have similar ownership or a common ownership, and it is them to have their tax reporting done under one tax group and a standalone entity, where all the tax affairs are consolidated for tax purposes, and a single tax return is reported for them. So, what are the benefits of the tax grouping if that is done? So, one of the I've described to you is the tax submission will. There is a consolidated tax return for all the tax group entities, the member entities. And when there is a tax grouping, the losses and the profits of the member entities are merged together so that their effective tax rate may become lower than the mandatory or the sanctioned tax rate that is available in the law. So if one entity is having a loss, other entity is having a profit, so their loss and profits can be offset together, and maybe a lower effective tax rate can result on their next taxable income. Another important thing for there is their compliance cost will will not increase too much. If standalone entities are reporting their taxation procedures and their taxable reporting and their taxable returns, tax returns separately, there is a problem of there is a separate cost that needs to be incurred for related to, let's suppose, audits and tax assessments and consultations as well with, let's suppose, for if they have hired on-site tax consultants as well. So the cost involved is quite high. But in case of tax grouping, there is a single tax return, and hence the cost is reduced quite a lot. Another important aspect of tax grouping is that assets can be transferred within the tax group without incurring any tax any gain any tax on the related gains or losses on the intergroup transfers. So let's suppose if an asset is being transferred within the group and there won't be any tax that will become due on the transfer between the group. Another very important aspect in relation to the tax grouping is the mergers and the acquisitions. When there are mergers, there can be spin-offs, there can be different variety of restructuring provisions within the group, tax group. So when there is a restructuring done, like for the share capital is altered, or some new investment is introduced into the group, into a company, there can be it can result in unnecessary tax implications. So in order to avoid that, tax grouping can be quite helpful, so that there is no tax implications on any gain or loss when there is a restructuring done, when there is any spin-off or a new company is separated so as a result of a spin-off, or there is a merger or an acquisition. So next up, when we are going to, if there is a formation of a tax group, obviously there has to be some sort of an administration of the tax group. So when we form a tax group, who shall be responsible for the tax group? In the draft consultation document, the FTA has proposed that there can be any number of members in the tax group, but there will be one tax group parent entity, we can so say parent entity, or the representative member who shall be leading the tax group. And the tax group shall be treated as a single person, as I have communicated already in the previous slide. One single taxable person, all the group companies shall be considered as one single taxable person, and all of their profits and losses shall be consolidated and reported as part of one single tax return. So it means that if there are intergroup transactions between the companies, like the sale and purchases, those need to be offset, those need to be eliminated when reporting in as part of their single tax return. So this means that effectively we shall be seeing consolidated financial statements more often audited consolidated financial statements as part of the finalization of tax reporting for large tax groups as well. And as I said earlier, there will be a responsible entity for the tax grouping, the representative, and whoever that is, that entity is, it shall be responsible for the consolidation of the tax groups and their reporting mechanisms in relation to their tax returns. And one important element in the tax grouping is that there shall be a joint and several liability for the tax obligations among the tax members. So it means that even though all the entities in the tax group are considered as one and their one tax return is submitted, but at the time of payment of the tax, if let's suppose one entity is unable to pay the tax, the tax due, then the other entities in the group become liable to pay the tax due. So even if let's suppose there are 3 entities in the group and 2 are unable to pay their tax obligations, the responsibility lies on the 3rd member of the tax group to extinguish the tax obligations. Now, an important element in tax grouping is how we can form the tax group and what are the provisions related to the tax grouping. So in the draft law that is provided, it says that that there should be a 95% of shareholding, common ownership in that subsidiary to form a tax group. So let's suppose a company has a 95% ownership in one of its subsidiary, only then it can form a tax group with its subsidiary. And the same procedure applies if, let's suppose, there is an indirect ownership. Let's suppose a subsidiary owns a 95% ownership in another subsidiary, or so in that case, that subsidiary can be included in the tax group as well. Important element you will notice in this regard is that the companies that are going to be included in the tax group should all have the same financial year. Now, in previously, Samir had mentioned that the financial years do not need to be changed for the purposes of the tax grouping, tax reporting. But in case of grouping, we will need to see if all the financial years of all the tax group participating companies are similar or not. If they are not similar, then the financial years would need to be amended. So effectively, the memorandum associations of the tax group participating companies should be amended in order to form a tax group. Another important highlight is the free zone entity cannot be a part of a tax group, and because the reason being that free zone entities have been provided much relief according to this draft document, and it would not be fair to other mainland entities if free zone entities are provided the relief related to the provisions of the tax grouping. Now, who can form part of the tax group? In indirect ownership, I have already explained this one. If there is a subsidiary being owned by a parent entity, it should be 95% holding, and only then it can be part of the tax group. Now, if there is a subsidiary, let's say the subsidiary holds a subsidiary with a 95% holding, that subsidiary can also become part of the tax group. This section is mostly regard to the administration. Now, if there is a wish of some group companies to effectively become a part of the tax group, they need to notify the FDA, something similar to what we have in VAT as well, if you want just to get a know-how. But there needs to be submitted an application to the FDA to do that, and you need to fulfill all the requisite criteria like the same financial year, no freeze on group member, and the 95% shareholding should also be satisfied. So this is probably the most interesting part of the tax grouping. Now, transfer of losses. Let me first explain that in tax grouping, when there is when the 95% criteria for tax grouping is satisfied, there is only one tax return for all the participating members in the tax group. So what does that mean is effectively the losses and the profits of all the participating tax group companies are effectively merged together, and one single taxable income figure is reported, upon which the due tax becomes payable and is paid in the end. But transfer of losses is a little bit something that is different. Let's suppose there are entities that do not qualify for tax grouping because their 95% ownership structure is not, they cannot fulfill their 95 ownership structure recommendation that is in the draft law. So in that case, those group of companies can still take benefit of the transfer of tax losses from one of their group companies to another, one of their company to another company. Let's suppose there is one company that has a gross income and another company that has a gross loss, and they wish to offset those losses. So in that case, they can offset those losses up to 75% of the taxable income of the receiving company. And the precondition, there is one precondition for that, that no losses cannot be transferred from the exempted company or those companies that are benefiting from the 0% corporate tax regime under the free zone. So effectively, free zone companies are not included in this provision as well. Now, intra-group transfers, similar to what I have explained here, intra-group relief or inter-group transfers will be available if the companies are at least 75% commonly owned. Just like I explained earlier as well, if there is no tax grouping because the 95% requirement is not complete, is not applicable, or it is not fulfilled, then even then you can get intra-group relief, intra-group transfers, or if the companies are 75%, group companies are 75% commonly owned. And what is the benefit of intergroup transfers, or what is the implications for the intergroup transfers? When there is a transfer of assets and liabilities between one group company to another, and the gain or loss that arises on that particular transaction, the taxation related to those gains or losses can be avoided. So the draft law provides for the avoidance of the tax on the gains or losses on intergroup transfers. And so it means that the assets and the liabilities can be transferred between the group companies on net book value or the book value in accounting, in general accepted accounting principles. So whatever those definitions you can find in general accepted accounting principles. So, and once these transfers are done, let's suppose if there is an intergroup transfer, we need to make sure that those assets remain within that transferred company for at least 3 years, and there is no further transfer, and the shareholding pattern also does not change. Like if it was like 70% commonly owned, it should remain 75% commonly owned. Otherwise, the gain or loss that was due on the date of the transfer, it will become due if those conditions within the next 3 years are not met. So considering all the intragroup transfer reliefs and the losses and the grouping structures that have been identified in the draft consultation documents, that there is much relief that is available for group companies. Most of the time, the group companies are like wholly owned, or most of their share capital is owned by their parent entity. So there is much to gain for group companies according to this tax law. Much like the intragroup transfer, there is restructuring relief provisions as well. As I mentioned earlier, there can be mergers within the mergers among companies, like two different companies that do not have common ownership. They merge together, and as a result, there is a common ownership that is born out of the merger. There may be some acquisitions as well. Standalone company buying another company with more than 95% shareholding, or there can be spin-offs, like one division of a company, like it breaks off from the company and forms itself into another company, another legal structure, wholly separate legal structure. So if there is such kind of restructuring done among companies or the tax groups, then the draft CT law is also very quite flexible in that as well, and it provides relief on the transfer of assets that is done among the mergers, acquisitions, and the spin-offs. So it provides for deferral of the tax or the exemption of the tax due if in relation to mergers and acquisitions. But the exemptions, and as I said earlier, these exemptions will not be applicable if there is a further transfer or restructuring done within the 3 years of the initial restructuring of the transfer. So that is all from my end. Now, I think Khushbu, we should move to the Q&A session. I believe we have so many questions as well from the participants. So I will give it to you.
All right, thank you very much, Mr. Zaki, for the detailed explanation. We shall now proceed with the question and answer session for the webinar. We have received some questions during the registration, and we shall begin with answering the same, followed by the questions that all our participants have asked during the session. And if there are any questions, you can add them to our chat box, and we shall try to revert back to every doubts that you might have on the subject. So the first question we'll begin with is, will there be a progressive tax rate or flat tax for all? Will accounting income be taxed or there will be a separate tax calculation? Is there any portal for putting the financial figures and tax amount will be calculated automatically by the portal? Mr. Samir, if you could please help me out with this.
Yeah, multiple questions.
Yeah.
I believe, what was the first one? If you can come again.
Will there be a progressive tax rate or flat tax for all?
So it's kind of progressive. So up to first 375,000 of your profits, company profits, the tax rate is 0. And any profits above 375,000 will be charged at the rate of 9%. But apart from that, there are no other rates.
Will accounting income be taxed or there will be a separate tax calculation?
That we already explained, I think. Hope this doubt was clear that the accounting base net profit will be taken, and then you will have to pass some adjustments with respect to the limitations on the expenses, and accordingly taxable profit will be calculated.
And is there any portal for putting the financial figures and tax amount?
Yes, for sure there will be a portal. Yeah, I remember that question. Yes, there will be a portal, just like VAT, where we put in the figures, but automatic calculation of tax rate will be difficult. Mostly it will be just like VAT. It will be calculated at the rate of 9%, but I don't think they will help you or assist. It's not practically possible as well to check regarding the ad bags or the 50% entertainment caps or interest caps. That manually has to be calculated and put in the figure.
All right. Thank you, Mr. Samir. Now, for Mr. Zaki, what are the preparations any company should start doing from this year for a smooth transition into corporate tax adoption?
Importantly, all the companies should take into account the opening balances that they will take forward into the next year when they are adopting the taxation, this whole taxation regime. So that is quite important, and it should be done deciding on their opening balances. I think it is highly important that they get their accounts audited and move those balances and move ahead with those balances, because things like corporate tax reliefs and the carry forward of losses, adjustments, those provisions will become quite important under the CT tax regime. And businesses should be sure that whatever the balances they are carrying forward, they are quite eligible in the new CT tax regime as well. So that is quite important.
All right. Thank you. The next one is, what is the criteria set for being eligible to file corporate tax, and what income, cost, and expenses would be taxable?
Yeah, the criteria for filing tax return will be provided in the final legislation, because as of now, income up to 375,000 is not taxable, and the free zone companies' income are also not taxable. But if there is an income beyond 375,000, and if you are within the scope of UAE corporate taxation, then naturally you will be required to file corporate tax return. Apart from that, non-residents who are having a permanent establishment or any foreign companies who are effectively control and manage and become resident, and if their income is beyond the minimum threshold of 8,375,000, then all those taxpayers will be required to file their corporate tax returns. But the final legislation may exclude certain categories of small businesses or startups as what they have assured in the public consultation document that they will provide alternate accounting standards. So we expect they will provide any relaxations from filing tax return considering the nature, circumstances and complexity of the business.
All right, thank you. What if the companies are loss on equity, the corporate tax applies? Also, if the company is still 51% ownership of an Emirati national, then also corporate tax slabs are the same, Mr. Zaki?
Zaki, you need to unmute yourself.
Yeah, thank you. Sure. So the corporate tax slabs will remain the same. There is no condition that the 51% ownership lies with the local Emirati and the 49% is with the foreign investor. The provisions are same for all. So same corporate tax rules will apply to the company. 375,000 up to 375,000 the income will be exempt, and above 375,000 9% shall apply.
All right, thank you very much. Next one is tax applicable for each license? Because we have 10 branches, we pay 10 license fees. So am I entitled to get $1,000 on each license? Over to you, Mr. Sameer.
Yeah, that's a tricky one. But as I've been saying throughout my webinar, that a branch is just an extended part of the main company. So in this case, I don't believe a separate 100,000, that's the 375,000 basic exemption will be applicable for each branch license. It will be for one main company only. But if it's in a free zone, if your branch is in a free zone, and then it needs to be looked into how exactly where all those 10 branches are placed, then a certain planning can be done.
There's another question that applies to the free zone. How will the corporate tax affect the businesses in free zone?
I believe we have covered this in detail, so it's fine.
Yes. So, Mr. Zaki, what will be the effect of this on VAT?
On VAT, obviously, VAT, the provisions related to VAT are quite different, and they are totally different. VAT is an indirect tax, CD is a direct tax. So VAT, there won't be any effect on that. There will be separate reporting for VAT and separate reporting for corporate tax. So both the ideas are totally different. So there won't be any impact on that, apart from the FTA being the sole authority who shall be dealing with both the tax regimes. Yeah.
Okay. So, Mr. Prateek, there's one more question that might be of your. Does drugstore also come under the purview of corporate tax?
Yes, because as per the plain reading of a language of public consultation document, that they have provided a specific 6 category of persons as per para 3.3 of public consultation documents. Only those persons' income is exempt from tax by way of being included in the public consultation document, or in future any income will be exempt by way of application only. So any business related with the drug will be covered within the scope of UAE corporate taxation, although it is exempt from VAT, but as far corporate taxation is concerned, profit will be subject to 9% corporate tax.
All right, I see Mr. Rashid Wazir and another user of ours are raising their hands. They might have some questions. So, Mr. Praveen, if you could please help out with this.
Mr. Rashid, you can unmute yourself and ask your question.
Good afternoon. My question is, we are a shipping company and we deal in the international trade of some spare parts and that type of business. So my business of international trade, that also comes under the preview of the corporate tax. And how about the shipping business? We are the owner of the vessels, okay, and we have rented out the vessels, but it's totally international dealing in that. So does it come under the corporate tax as well, or what's your comment on this?
I would like to take this question. So, Mr. Rashid, if you believe, I had spoken about the exempt incomes. So, in that, I had mentioned about operating or leasing of aircraft or ships, but the condition for that was it was only the applicable to the non-residents. So, if a company who is registered in a mainland UAE and who is operating in ships or aircraft, I don't believe it's exempt income. Corporate tax will be applicable. It also depends on where your company is registered. If it's in a free zone, then again, free zone rules will apply and it will be not be applicable, since as you are saying, it's all international. So it will totally depend on where your company is registered.
It's in the mainland.
Mainland, then I think you need to do some restructuring and plan it so that you have a level playing field with respect to your corporate tax.
Okay, perfect. And how about the international trade of
Once you are
spare
in
parts or
mainland,
something?
it's irrespective whether you are doing international generating income from international transactions or local. It's going to be straight away 9% on the profits which you are going to make.
Thank you. Thank you.
So we shall proceed with certain questions from the chat box as well.
Yeah.
So there's one from Mr. O. Zubi, which says that will corporate tax apply to offshores or free zone companies that are dealing outside the UAE?
Again, I think it's pertaining to me. So offshore companies, it's part of free zones only, and if they are dealing outside, then corporate tax they will have to register, but again it will be at the rate of 0%, providing the conditions which they have put forward. Those conditions should be maintained at all times.
There's one from Mr. Mohammed Shoaib, which says that does audit financials require for corporate tax calculation, or companies can calculate tax according to their internal financials working or the management accounts?
Zaki?
Should I take? Yeah,
Yeah.
all right. Yeah, as I explained earlier as well, in order for us to move smoothly, make a smooth transition from the era before the corporate tax regime and after corporate tax regime, it is quite imperative that we do our audits, financial audits, and so that we have the most reliable opening balances. But moving forward, moving forward in the free zone, audited financial statements will be mandatory, and in the mainland as well, it is mostly expected they will become mandatory. So it's better to get audited as soon as possible, and yeah, move forward with that.
All right. Thank you. So there's one from Mr. Vinay, which says the first tax period is from 1st July 2023 to 30th June 2024, and not 1st June 2022 to 31st May 2024.
I think it is referring to the previous slide which I had covered.
Yeah, okay.
So it was just an example that in case a company has or is following financial year as from July to June, then it will be applicable for them from 1st July 2023. So yeah.
And there's also a clarification needed on the financial year, because if the financial year is from January to December, then the first return would be filed on what date?
So if the financial year they are following, I think I covered extensively. If a company is following financial year as financial year will be from 1st Jan 2024 to 31st December 2024. And accordingly, as per the draft law, they have mentioned that 9 months time will be given to file the return after your financial period has ended. So in this case, it will be by 30th September, on or before 30th September 2025. they will have to file the return and also pay the corporate tax.
There are two questions from Mr. Atif Mahmood. The first one is, can you carry forward losses into next period or can you carry back into previous periods?
Zaki.
Already
Yeah.
listed in chat box.
Can you
I
carry
think-
forward the losses into next period or carry back it into the previous period?
Well, the draft law that has come forward, it has only, the draft consultation document that has come forward. There's only the provision for carry forward of the losses, not the carry back of the losses. So maybe when the draft law comes, eventually comes, there will be carry back of the losses, but carrying forward the losses, that is for that can be done, and there is no limitation on the number of years how long it can be carried forward. So it is indefinite.
All right, and there's one more which Mr. Zaki could answer, that IGR, if applicable, how much can we claim against the taxable income?
Sorry.
IGR, integrated tax.
Intra-group relief, I think.
Intra-group,
Yeah,
sorry.
intra-group relief. Yeah. So 75% you can offset against the profit of the up to 75% of the taxable income of the company receiving the benefit.
Okay, there's one that how and where do we have to register for corporate tax, be the free zone company?
Sorry.
Well, that
How and where do we have to register for the corporate tax, being a free zone company?
That I think Zaki, admin part.
sorry.
How and where do we have to register for corporate tax, being a free zone company?
I think those procedures will come out when the law is eventually released, and there will be some website just like the current procedures we have with the VAT. There will be some procedure to sign up and provide all the necessary documents and the details and apply for registration with the FD.
So I guess we've answered many questions and almost everything that we could find on the chat box have been covered up. Just a moment.
So yeah, just in case, so if we have missed out on any of your questions, I believe we'll revert back to you. You can also send us your queries on our email IDs, I believe, and whoever has registered for this event, we'll be sending you the email of the presentation so that you have an idea. And if you have any questions, you can write down to us. You can reach out to us anytime. I hope it was an informative session and you all guys enjoyed it.